seen this, and it used to be Silicon Valley is king, and then a year ago, The Economist published this, and people are leaving, and it's every single day. I kid you, every single day, multiple people, maybe 10, 20 people show up at Capital Factory from San Francisco. Like every single day. Every single day, there's a company that comes in and shows up here, and that's what's, the trend is our friend. It's a great place to live, great place to work. Austin, 11th largest city, super fast growing, great infrastructure from the university. Most of the major tech companies have some of their second, HQ2 hub here, and then awesome startup community that's been well developed by Capital Factory and all the other accelerators and incubators in town. Dallas is really strong. Dallas, my unique perspective on Dallas is, while Austin has the early stage seed phase thing down, in Dallas they know how to scale businesses, and they do big business very well, and they know what it means to go from $20 million to $100 million in revenue, and that means a lot when it comes to paying back the investments in the early stage phase. Houston's it's deep tech. Like, my joke about Houston is you never see a startup pitch deck without advanced calculus on it. And it's the only place you see that, where there's always some graph, but it's really interesting, and they have got very a strong roots at the Texas Medical Center, which is a leading world-class medical center that has an awesome innovation program. Rice University is developing a whole building around innovation downtown Houston. And then, like I said, there's 25 Fortune 500 headquarters, and so if you're an energy company in Austin, you can go wake up, go sell to 3 customers in Houston, and come home and sleep in your bed, and you can come recruit and build your development team here. I led a meeting in Houston this morning, and that meeting ended at noon, and I'm back here leading this now, and that's the advantage. That's like the competitive advantage of Texas is our geography. There's no other region in the world where you have so many major cities within a day's drive, and you can wake up in any city, drive to any other city, conduct a full day's meeting, and come home and sleep in your bed and eat dinner with your family. And San Antonio is it is the largest military city in the world, and you have USAA, Rackspace had a phenomenal run there, and Geekdom as well. So very, very interesting. And Texas. So I touched on all of this, but 4 of the 11 largest cities in the United States. If we were a country, we'd be the 10th largest economy in the world by GDP. We have great Fortune 500 companies, and ultimately it's our job, everyone in this room and everyone participating in this community, to make it the best place for entrepreneurs to. Sweet. So we've had some great successes. Just to roll through a few companies in Austin. Bumble came out of Austin, Reward Style in Dallas. We'll get some more in a second. And all the things I just said is about the past. Nothing's slowing down, right? It's only speeding up, and that's what's really exciting. The next 10 years are certainly going to be better than the last 10 years in our eyes, and the last 10 years have been great. So that's the idea of the Texas Manifesto, is one megacity. Through Union, so we have a software platform. If you're a member at Capital Factory, you'll be on Union, and that gives you access to these different tech hubs online throughout the state. And so, for example, in Houston, we have a staff member in the Cannon, which is a new co-working space there, developing a mentor network for Capital Factory and for the Cannon, where members there can come and log on virtually with members here and meet online, or maybe drive over for the day, and it's almost like a match.com for startups and mentors. So here in Austin, we're at the Austin Center, just a few of the locations. In Dallas, we're at Cedar Springs and Oaklawn. It's more of a retail space. It's actually a little nicer in my opinion. We opened that just over a year ago. We do bus trips over there. All of our members and all of our mentors are invited on these bus trips. We saddle up at like 7 in the morning. We go up to Dallas. We do 8 to 10 curated one-on-one meetings. So we have a team that sits down and literally puts together a speed dating event for a bunch of investors, mentors, and entrepreneurs in Austin to meet with a bunch of investors, mentors, and entrepreneurs in Dallas. And we coordinate that. And then after the one-on-one meetings, everyone goes into a big song and dance with a happy hour and a dinner and a panel. And then we come home and sing songs on the bus. and it's sponsored by Capital Factory as part of your membership. So our team, we're likely going to surpass 100 full-time employees at Capital Factory this year. I think we're at about 80 right now, and it's super unique advantage for us to have that staff and that infrastructure with people. We have a full team dedicated on engaging corporates in the ecosystem, a full team on acquiring new technology that our members can build on. So we have a tech lab that has VR, that has AI, all the devices you can use. We have a podcast studio, a green room. These are all the infrastructure that we have, and we have staff that goes with that. It's not like you need to know how to use any of that as a member. You can go book time with our staff that runs all those resources, and they can help you produce your first podcast for your company or make your first teaser video just right downstairs. So that's the manifesto. I'm gonna keep moving. Let's see what time. Okay, got 7 more minutes, and then we'll break into the into the AMA. So this is a little bit about fundraising, some questions with bootstrapping versus VC, or really why do you want to raise money? I think I don't know what Josh usually says on this slide, so I'm just going to just tell you my main opinion. The goal of your company is decided by you, and there's a lot you can do without raising outside money. And I'd encourage you to do that if you can, right? But some people have higher goals, and some people don't just want to build a business. Some people might want to build $1 billion business or change the world. And usually that's when the investors need to get in that short period of time. I don't want to try to confuse you with that slide because I don't know exactly the things. This point, I do know, when you're raising money from an investor, it's almost, they're never going to write you a check on the first date, right? It's not one interaction, and so don't overhype yourself with that first meeting. Really, the first meeting is just the get to know you phase over the course of building a very deep relationship that could be ended up looking like a marriage, or potentially I think even more complicated than a marriage if they do invest and you go build a company together. So the seed round. So Josh Bayer, our CEO at Capital Factory, wrote a blog post with these 5 points on raising a seed round. It's a moving target, but we think these are some great goals to strive for. Do people raise money without hitting these milestones or without having these attributes? Yes. Do some people hit these attributes and not raise money? Yes, but almost every investor you talk to is interested in the team. Like, why is this person the one to build this into a really big company? And that's the other big thing is you got to be aiming to build a big company. There's very few investors, at least early stage venture capital investors, that are looking to build a $10 million company. The investors know that they're going to lose money on 9 out of the 10 early stage startups they invest in, and so the 1 out of 10 that is going to provide the returns needs to provide returns for all 10 investments. And so that's really what drives this unicorn craze is the need for that 10x return. And so in order to get that big return, you have to be addressing a really big market, a really big problem. Usually to get a seed round, you're going to need some traction. There's so many resources out there, whether like Canva is I think one of the latest ones I love, for your pitch deck. If you're ever thinking, do I need to go pay a designer $5,000 to make my pitch deck? No, go download Canva and it's free, and they've already done that and paid them and made it free for you, or you pay $15. But and that's just one example. And you've got Slack and you've got social media and all of these grassroots abilities to put a company together. So some type of early traction. I think investors really want to look for the evidence your product creates value, or evidence that your solution is going to really change the world of your customer, right? And so, and that's best done with someone paying for your product or making a very contractual agreement to pay for it once you build it. Getting a social proof from a key investor is important. So if Mike says he's going to invest, that's going to get a bunch of other investors really excited.
Probably not.
Maybe some investors will run for the hills, right? It's kind of a polarizing thing, but no, I think if Mike did say Live Oak Venture Partners is going to commit $5 million to a $1 million round, you're going to get to pick from a selection of people who's going to fill out that round. Not everybody's going to come running, but really it's that lead. So the first, focusing the first investor to be someone that other investors will follow can be a great advantage. You usually need a minimum viable product. It doesn't have to be super robust, and it doesn't have to work perfectly. It can break, etc. But it should be something that people are willing to pay for, and that solves the problem at a basic sense. Okay. So you guys can, I won't walk through all of these, but we have built out a ever-changing list of accelerators in Austin, I think across Texas, angel networks as well. If any of y'all have updates to this, I think almost every week there's updates, feel free to email us. We love to add folks. Here's some of the seed stage investors, a few more, Series A investors, corporate investors. I know we can add a few to that. Some new funds. There's been a lot of new funds, which is exciting. One thing, I just read this in a book. If you're curious about venture capital and the whole game, I'd recommend Secrets to Sand Hill Road by Scott Kapoor. Scott Kapoor was the first employee at Andreessen Horowitz. He's now a managing partner. But one thing he pointed out in his book that just really, it's like one of these things I knew but didn't think about. The amount of deals that get done in a startup ecosystem, the amount of investments are made, is not set by the number of companies that are fundable. Right? Just because you have a fundable company doesn't mean that you're going to get funded. The number of deals that gets funded is set by the amount of LPs that are willing to invest in the venture capital funds that then go invest in your startups in the ecosystem. And so when you see a bunch of new funds coming together, that means more people are investing in venture capital funds, which in turn is going to make it a lot easier for you to raise money. Some more tech VCs. Almost every, I think, major VC that is looking in Austin at least. Most of them have already made one investment. I really don't believe there's many funds that are strictly investing in Silicon Valley. I couldn't name one off the top of my head. There's probably a few, I'm sure, but generally it's the world is flat when it comes to VC. Some more CPG focused VCs. Some reading lists. I'm going to kind of fast forward. Sweet. What time is it? 4:45. I'd like to welcome my guest, Mike Marcantonio from Live Oak Venture Partners. Mike, you want to just take a second to introduce yourself and dive in?
Yeah, absolutely. So I'm Mike with Live Oak. We are all based here in Austin. The firm was founded about 7 years ago. Three founding partners had worked together for a decade at a firm called Austin Ventures, which for a long time was pretty much the only venture firm in Austin and one of the few in Texas. They spun out, raised about $105 million fund, investing only in early stage and Series A companies here in Texas. So we are now in Fund 2, but same strategy. We typically invest $1 to $4 million initially, across a variety of industries. We like to lead rounds, so we are the key investor, as Nick put it, to help price a round. We like to take a board seat, and then we're there for the life cycle of the business. So we'll reserve capital. We may end up investing $6 to $8 or even $10 million into a business over the life of it. We just started investing out of Fund 2 last summer, same size. We've done about 8 deals out of that fund. It'll probably be 22 to 24 total. So a lot more investing to do out of that. And
so whenever you ask a VC to introduce themselves, they introduce their firm.
Yeah,
which is great. Tell us more about your background.
Yeah, so
get to know you a little bit.
I moved to Austin about a year ago, which I think makes me a veteran these days. But originally from the East Coast, I grew up in the DC area. Went to school in Virginia at James Madison. Worked in accounting and finance for most of my 20s. Public accounting and then private equity, and then kind of worked my way earlier and earlier as far as the companies I was interacting with. For the last 6 years before moving to Austin, I was with a venture firm in Richmond, Virginia, doing early stage growth and some later stage deals. But I married a Texan along the way, a woman from Abilene, and the force is strong with Texas women. So we were looking to get to Austin for the last few years. Unfortunately, found Live Oak last summer. We've got 2 little boys that are going on 3 and 5 next month. So I'm busy between family life and Capital Factory events.
Awesome.
But yeah,
Thanks for being here.
excited to be here.
Cool. So we can dive right into your questions. I have questions, but
Yeah.
So Mike, how would founders go about starting a relationship with Live Oak? So we know it's not a one and done kind of thing, but starting that long term.
Yeah, and that's a great point by Nick. We take a lot of meetings where our company is ready to pitch and they've got their deck and they need to raise money in the next few months, and that's great. We're happy to take those meetings, but the best relationships are the ones that start 3, 6, 9 months before you're looking to raise capital, or at least where we would fit in. And so there's a couple avenues. We certainly review every deal that comes through our website, and you can go on, there's a button to submit your business plan and a little bit of information, and we review all of those. Meeting at events like this is always great. That's why I come and do these, because I want to get to know more entrepreneurs in the community. I think the most popular advice that you'll see out there is to somehow network your way into one of the entrepreneurs already in our portfolio and have them make a warm introduction. And that is great. We love to get those folks that are friends of our family get high priority, so to speak. But by no means is that the lone way to get in. We're in the business of looking at as many deals as we can. So I know some folks think it's hard to get in front of VCs. We try to make ourselves more available. So I would just encourage you to, whether it's events, the website, or friends of friends, even LinkedIn these days, works for most everybody. Another tip, as you're reaching out to Live Oak or other firms in town, folks like myself at the principal level or folks that are at the senior associate level are probably more likely to respond. And our goal is to feed deals that are interesting for the firm. So you're going to get partner attention, but you don't have to go to the partner initially. They tend to be a little bit more difficult to get a hold of. So, other questions?
You guys just recently raised the Series B for Talent Guard here in Austin. I was just wondering since you say you focus mostly on seed A and early stage, what made you go after it?
Yeah, good question. That is a business that probably is a profile of a traditional Series A company, but over the last 5 years, definitions of fund or the round, seed used to be a Series A. Series A today kind of blends with a Series B 10 years ago. So Talent Guard is at a point where they're at a couple $1 million in revenue. They're growing nicely, but they'd already raised 2 rounds previously, and it just basically named them Seed and Series A. So,
what was the size of the round?
About 3.5.
Okay.
Yeah, I think there's room for 4. So between 3 and 4, and we did 75% of that. Previously, I think Linda, the founder, had raised a couple $1 million from angels and folks around town.
What type of revenue are these seed companies generating? I'm sure it's pretty early in the growth. So.
Yeah, and we don't have a hard and fast rule. So generally for seed stage deals that fit with us, they're companies raising between $1 million and $2.5 million in seed. If you're looking for a couple $100K, probably not a fit.
But what are these companies generating?
Yeah, they can be anywhere from 0 to most
negative.
If it's a company without revenue, it's probably one where the founder has had an exit previously, or we've worked with founding members of the team and have a relationship where we're willing to go a bit earlier than our comfort zone because we have that personal relationship. But random company off the street that's at a seed stage, 20 to 30K is where it starts to get interesting and where you've got some evidence of referenceable customers. People are actually paying for it. You have a little bit of cadence around the sales.
And that's 20 to 30K over what sort of time
per month.
Per month.
Yeah, doesn't have to be a recurring revenue business, but most companies these days are trying to fit themselves into that box. So 20 to 30K recurring, and hopefully that's growing a couple K, 5K a month, sort of pacing. Yeah.
When you're looking at revenue, do you make a distinction between NRE and product sales?
It's great to have any sort of revenue early on, so we're not going to discriminate and say, oh, you shouldn't be doing this one-off project. But we're going to get excited and you're going to be valued off of what's recurring, generally speaking. So to the extent that you can work contracts into more of a recurring nature, it's going to be to your benefit from a fundraising standpoint. Some business models just don't fit that, and we get it. Some are purely transactional. Others are a blend if you've got a hardware software combination. So it's okay. Don't try to fit a square peg in a round hole. But when you look at valuation multiples and things like that, recurring revenue is valued much higher.
So Nick was talking about some milestones that companies can try to achieve in order to sort of get their foot in the door or make them more salient to VCs. And so I had a question. How's the phrase meaningful customer traction different for Texas VCs versus VCs in the rest of the country, maybe particularly California?
Yeah. Here in Austin in particular, and this goes with the venture firms in Houston, Mercury Fund is a group there that looks very similar to the firms here in town. We fit into that seed and Series A bucket, and as Texas defines it, that's companies that are starting to generate revenue, that are raising a couple million to maybe 10 million is a large Series A. In the Valley, seed can be anything from company with no revenue and no plans to generate revenue for 2 years, raising $20 million, maybe they're only raising a couple, to a Series A that's raising 30 million. So there's a much wider variance in what a company can look like, and there's investors that are more comfortable with businesses across that variance. In Texas, we fall more into the niche of some sort of revenue generation, $1 to $5 million initial investments, and deals that are kind of in that $1 to $10 million fundraise. So there may be a company in town that's a big AR, VR play that requires a lot of capital. Probably going to have a harder time raising money here in town, but maybe right down the fairway for some of the groups in the Bay or New York. That's hard to ascertain without talking to a VC, but.
Do you guys do more B2B or do you also do B2C? And also wondering, off those tangents, do you guys do any of the longer, like, build a base of user interaction before you start selling stuff to them?
Yeah.
Do you guys do interplay?
Yeah, because we have narrowly defined our focus as Texas only, we're somewhat dependent on the types of companies that grow here, which historically has been heavier on the B2B side. So if you look at our portfolio, and even going back to the founders' AV days, it's heavy B2B software. But that said, we will look at e-commerce, we'll look at some CPG, there's some marketplace opportunities, and then we will look at products that probably need and should build a user base over the first 24 months or 18 months of their life before they worry about monetization. We'll certainly take a look at it. It's not our sweet spot, so there's going to be probably a slightly higher hurdle, but we would absolutely do that. We looked at a company on the east side called Coder that is doing really well and raised a bunch of money from the West Coast. I don't know if you guys got in there, but they're awesome.
We got in.
Nice. It's an IDE platform that's crushing it.
They're killing it, yeah.
What was the most memorable pitch you sat through and why?
Oh man, probably a deal we did out of Fund 2. It's a company called Imandra, IMANDRA. I saw the pitch at a very random pitch event where some local business broker got some companies together to pitch, and I told the partners I was going to it, and they kind of looked at me sideways like, yeah, we know those events and we never find anything interesting there. And I sat through like 6 pitches that were not very interesting, and then this guy came up to pitch. Off the charts smart guy who's a PhD in computer science, was teaching at Edinburgh and Carnegie Mellon at the same time, and 90% of what he was saying was way over my head because I'm not technical by background.
Is this the guy doing the Bear Stearns or the Goldman Sachs?
Yeah, so
he's rocket science smart.
Yeah, and his co-founder was his UT roommate, who's also off the charts smart and was running the risk management desk for Deutsche Bank in London. So the two of them teamed up, and their software, basically, what it helps you do is if you've got software or an algorithm, it can test every single edge case and tell you where your algorithm would fail. Historically, you would rely on some smart guy sitting in the cube next to you to come up with some random edge case and test it and see if he could break it or she could break it. This tests every edge case and tells you where it fails, and so that's valuable in things like financial exchanges where there's very strict rules and people want to make sure their trades are executed according to these rules. They're not getting front run or someone's jumping in line. There's very heavy fines if that sort of stuff happens. And so they're working with Goldman Sachs to make sure that one of their internal exchanges is operating according to the 200-page guide that they share with their customers. There's potential applications to autonomous vehicles, where you think about all of the possible scenarios. A vehicle could come in at an intersection or on a highway. How does the software decide what action to take? Do I slam on the brakes? Do I swerve? Do I run into the car in front of me because that's the best outcome in this given situation? As autonomous vehicles are going through their kind of rapid maturation, one of the big struggles is to ensure safety and that they behave according to how the engineers designed them. So Amandra, when he started going through all of these possible use cases, my head kind of lit up. And then had them in to meet with the team about a week later, and I think we shoehorned our way into the deal within like 4 days after that, because they had already had most of the capital lined up. So that was a fun one. Still very early. They've got 3 customers today. So, yeah.
When a company comes to you, how many equity in the average should have the founders team, and how much do you care about this?
Sorry, repeat the first part?
How much do you care about how much equity the founders have?
Yeah.
Which is the right value?
Yeah. We care a lot, so we want to make sure that everybody is incentivized to stick with the business for the long term, right? We're investing, and most of our companies will be investors in them for 3, 5, probably close to 7 years. And so if the founders are not properly incentivized, primarily through equity, 2 or 3 years in, they may get the itch to go do something else, and that leaves us as the outside investors holding the bag, so to speak. So when you're going out to raise a seed round or a Series A general rule of thumb would be plan on 20 to 25% dilution for the existing shareholders. So if you think a team of 3 starts a business, they've each got 33%, they go out and raise their first round, that 33 gets diluted down by 25%. And then the next round, hopefully it's a little bit less, 20-ish%, and then as you grow and things go great, you can drive even less dilution.
What about solo founder?
That's a great scenario to be in. You know, the question with a solo founder is usually not, are they properly incentivized, but do they have the resources and team to take on what it takes to go into scaling a business? So in those situations, we'd be looking for helping to surround them with either co-founders or just early management team and VP level talent to make sure that there's enough bodies on board. Yep.
How concerned are you about voting rights?
What rights?
Voting rights.
Okay.
You know, there's certain protections that we kind of have to have for our LPs and that we'll share with our investors to make sure that we can be good stewards of their capital. But as it relates to specific voting rights, it can be deal by deal. You know, most often we are going to be minority investors in a preferred share class. We're going to have 1 seat on the board. The board will probably be 5 people, maybe only 3 if it's very early. So it's not until you get into later rounds where a venture investor or a group of venture investors will have any sort of authority over most aspects of the business.
But you'll look away if the founder has 60% of the votes?
No. Generally, no. Usually, from a protective provision standpoint, we'd want to have the ability to make a change to management if we feel like the founder or someone else on the team is not performing, and that's not even, we don't always have that ability. So a founder maintaining control is pretty standard, actually, at least in the seed stage. As they raise more money, it usually becomes a mix of investor and common shareholders or founders. Sure.
How much equity do you guys typically take in a deal?
So we target 20 to 25%. Occasionally it'll be less than that for some of the deals that are a little bit further along. Sometimes there's not room for us to get 20 to 25%, meaning I can't invest $4 million. Other people have already spoken for most of the round, so it can be less than that. But most institutional venture groups are going to have that goal of 15 to 25% with their initial investment.
What type of restrictions do you put on the money that is raised? Like, does it have to be growth capital? I mean, what if it's a small, profitable, and the founder wants to take some off the table?
If it's a business like that, there are plenty of investment groups out there, but they wouldn't market themselves as VC firms. You'd probably find growth equity investors or more like private equity firms that would be comfortable giving more cash off the table and buying a larger share of the business. In some of our deals, some of the Series A and later stage ones, we will carve out a portion of the round to cash out some element of the founders or the management team. But we want the vast majority of the capital to go towards growth. Yeah.
So, Live Oak started having exits, and how do you think about that, both for the firm and also just for Austin? Generally, I think like there's a lot of liquidity of transactions in the Bay Area. How do you think about that here?
Yeah, so we the way our funds are structured, and it's like most venture funds, our investors invest with us knowing that they're not going to get their full return for at least 10 years, and in some cases it's 12 years. Over the first 4 years we invest in these companies, call it 20 companies, and then over the last 6 to 8 years they start to sell off. And it's generally not something that we push because we're minority investors. We don't have the control to force a company to go sell. But the natural life cycle of these growth stage businesses is within 4, 5, 6 years, either the founders are ready to sell or collectively we've reached scale and everybody's ready to take some chips off the table. And so there's kind of this natural cadence. From Fund 1, we had a couple nice exits at the end of last year. A company called OpCity that was growing really quickly was acquired by a strategic, and that was a deal where we would have loved to continue to ride the wave with them. They were doing really well, but it made sense for the founders. It was a great deal as far as the valuation, and so we weren't going to stand in the way of that. The deal got done. Digital Pharmacist is another business that sold last year where a private equity group came in. We weren't marketing the business for sale, but two groups showed interest and kind of played them off each other and had a great outcome. I think those stories are great for Austin because it gives entrepreneurs confidence that Austin companies can go out and have success. It also breeds more entrepreneurs. There's folks that have spun out both of those businesses that are now at younger, early companies in key roles. There's at least one former digital pharmacist employee who's launching a business today. And so it just feeds the ecosystem with both capital and talent when you have those successes. Yeah.
Are you guys making any adjustments in either on your future investments or talking to your current portfolio companies, looking at, we're likely heading into a recession and going to have public market downturn? So are you tweaking anything you're doing, or just like, hey, we're 12 years out in the future, so heads down, let's just keep doing our thing?
Yeah, we are not doing anything specific to that risk, primarily the primary reason is me and my team, we're not in the business of predicting broad market downturns. So people have been predicting it for 4 years.
I know,
the next recession was coming around the year.
That big thing, 3 or 4 years ago came out, all the VCs were like calling for that.
And so it's really hard to call that. If I could call it, I could go make
collapsing ISM and yield curve.
Yeah, I also not the business of predicting it, like but I do know.
Yeah, it's going to come, and there will be negative repercussions for our portfolio companies. The other side of that equation is that once it starts to ripple down, and it starts with the public companies and works its way down, valuations for the companies we're investing in will come down. And so it may be that you've got this barbell look to your portfolio where the companies early in the fund were at slightly higher valuations and are struggling as the general economy struggles, but the deals later in the portfolio are at better terms and are businesses that are actually performing in the new economy, the downturn economy.
The other interesting part of that situation, because you talked to a lot of the investors that were around in the dot-com crash, and I think depends on where the money's sitting when it crashes.
Yeah.
And it's like if your competitor raised $2 million 18 months ago and they were on the verges of closing their Series A, and then you raised $2 million a month ago, when that market drops, you immediately flip position in the market, right?
Right. So, yeah, you've got capital to ride it out.
And the same thing with your fund. If you're early on in the fund and you've got a fresh fund with $105 million, versus all the other funds that don't have any money, so it's like where the money's sitting when that happens is what matters.
sounds like you know the space pretty well. The best fund returns are the ones that are vintages during the post downturn,
Right.
2 years into it or a year into a recession. So in theory, that's good for venture investors, but it's painful along the way.
I mean, because VCs are obviously, because of the way the structure's set up, and looking for that home run. Cause like for instance, like for a sales engagement acceleration platform, that's focused right now on B2B, but eventually want to, market to B2C as well. But, so I guess what I'm getting at is, you know, to have that quote unquote $1 billion valuation one day, or you know, ultimate exit or whatever, you know, whatever the home run is, would you suggest, you know, sticking to B2B at least initially while, you know, while building the company, and then maybe building other product lines and you know, features on the platform that would service more B2C type companies?
Not necessarily. Not knowing the business beyond the 30 seconds there, you know, inherently the entrepreneurs know a lot more about their business and hopefully have a much closer finger on the pulse to what the market needs and where the product's going to resonate. And so if you intuitively feel like ultimately the B2C play is the larger opportunity and where you'll get more traction, then I would suggest going in that direction first. There's not really a valuation disparity, or there is, but it's not meaningful, between a B2C business that's doing well and a B2B business that's doing well. If your question's more like, how do I get to critical mass, you may have it may be easier with larger B2B contracts to get to a couple million in revenue and have some confidence that you've got a real business that can scale. And if that's the case, then sure, going B2B for 12 months, 24 months might make sense. But I wouldn't discourage you from going down the path that you think ultimately this is where the product belongs, which is in the consumer's hands. Don't try to guide it towards what the investors want. If you build an interesting business, there'll be an investor there for you.
Yeah, I mean, because ultimately, I want to include both B2B and B2C, but, you know, obviously because B2B, like you said, exactly what you said. I mean, it's quicker to revenue and get contracts a lot quicker, but you know, the B2C side, as far as the platform, hasn't been built and developed as much, so that's kind of, but, you know, again, that's part of the bigger vision, so, no, that's a great answer for you.
Yeah, so this is kind of addressing two of your answers. I just want to make clear on something. Coming from Arizona, where the ecosystem for investment was, when it pertained to tech, was all medical. To the point where everything else is kind of, you know, we don't understand that space as a response. You mentioned earlier, you're supposed to talk about VR and AR and, you know, sales and whatever. Is there an ecosystem like that here? Not for medical, but is there an ecosystem that says, we like this kind of tech, we don't like this kind of tech? If it's helped direct the question, I'm a video game guy, and is that something that is not?
There are a couple folks in town, and there's a Capital Factory portfolio company, Chrono GG, who you should meet. It's going to be a subset. I will say, you know, gaming. You probably go to Dallas, and given the esports presence there, you'll have folks that get it a little bit.
Frisco, not even Dallas.
Yeah, go to Frisco, and you'll have folks that get it a little bit quicker. For me, we looked at this gaming company, gaming related. It's not true game development, and it was compelling and interesting, but it's a higher learning curve for me to get up in order to get comfortable with a space that I don't see a lot of. And you'll probably find that with other investors in town, where they're very willing to listen and try to get smart and understand the business, but if we don't see a lot of these regularly, it's just harder for us to get that conviction that we know it's an interesting opportunity in that space. And so it may be that it's Frisco or it's, I don't know, New York or LA, where you have better success just because the investors are more comfortable with that sort of opportunity.
So a little uphill, but not.
Yeah, no, certainly not. I mean, there's a guy in town, Justin, who owns an esports team. There's Chrono doing well on the gaming marketing side. There's groups that are more consumer oriented in town that understand how to market to B2C versus a B2B play. So,
I think look, what's unique about being in Austin is you can, like, all the other investors around the world will invest here, right? Or like 90% of them. And when we're working with our companies that are raising funding rounds, it's, you know, they immediately come in, it's like, who in town can we meet? It's like, well, you probably already met a lot of the investors in town, and you know, it's like, but, you know, we've got a network around the world that can drill into what you're specifically at. And so I think it really, you know, shedding, at least nationally, but even maybe globally, shedding these geographic thoughts around who you're raising money from is a good strategic move.
Yeah, sure.
I was gonna ask the same thing, like raising with you guys, for example, do you provide more than just money, where there is a little bit of a strategic partnership there? You do help out with
I think any venture fund is going to tout some sort of strategic element to them, and hopefully they have. Most do, some don't. Some are fine just writing a check, but they're in the minority. With us, because we are investing solely in Texas, I think our biggest benefit is the network of folks that we can call on, primarily from a talent standpoint. So as you're building your business, there's going to be a number of key hires over the years. And being able to pull on folks that we've worked with in the past, other portfolio companies, or that have come out of HomeAway and Retail Me Not and large successes in town, and plug them into key roles is very helpful. Some of our portfolio companies have been in the news lately, Ojo Labs in particular, for drawing really high-powered people from Google and Amazon and Apple. And those were people that we didn't necessarily introduce them to, but it's because the team that they were coming in to work with was so talented from Austin. So that's a big one. You know, some firms will try to tout the customer relationships that they have. I would say that that's a lot harder to do, and most fall short there. So hopefully it's on the talent side. Hopefully the personal relationship with the partner that's leading the deal is strong, because that's a person you're going to be in bed with for a number of years. And beyond that, you know, some of these groups have platform teams and a variety of things that they're trying to do, but that's our differentiator. Yeah.
So a lot of the companies we're talking about delivered a software product.
Mm-hmm.
Is there room in Austin for a product that's really software and hardware in the end?
Yeah, I think so. We have a company in Dallas, Raspberry, that is hardware and software. It's a sensor that sits out, like, think of an IoT type device, captures information, software does its magic, we feed it back to the customer. They're doing well. We funded them a few years ago. And other investors in town will certainly take a look at hardware-software combinations. Generally speaking, if the revenue is going to be heavier on the hardware side, you may need to look out on the coast as well. You know, again, the firms in town will certainly take the meeting, but there are some more hardware-focused firms popping up back on the coast after being out of vogue for a number of years, starting to creep back into vogue a little bit.
I'm curious about something. I submitted a presentation for South by Southwest panel giver, and so hopefully I'll get enough votes to get that.
Mm-hmm.
I'm wondering, how important is it for someone like you, if I were to present that? Would that impress you? Would you?
Yeah, I think anytime there's a competition, there's whether it's pitch competitions and you win prize money, or South by where you get exposure by sitting on a panel, there's a level of validation that comes with that. For me, it's a place where I'll try to source deals. So I'll read as much as I can on who's winning competitions, who's doing what, getting their name in the news, and try to reach out. After that, though, it'll really come down to the business. It's an initial marketing to get some exposure for your business, but it's not enough social proof for us to say, well, South by picked them, so it's good enough for us. Is that helpful?
Yes, thank you.
What's your preferred form of investment? Straight equity, notes?
Yeah, preference would be preferred equity. So we are comfortable investing in notes. It's not uncommon for seed stage deals, but we're very comfortable pricing around. We'd much rather know the price that we're getting in at now, and then go from there.
How do you do that, by the way?
Smoke and mirrors. No, valuation's tough, particularly the earlier the company is. Some rules of thumb, because it's too hard to throw out a revenue multiple. The variance is too wide. Maybe I will in a second, and then backtrack on that. But if you're a seed stage company, let's say you're at $20,000 a month of recurring revenue, and that's starting to tick up. And you're going out to raise a $2 million seed round. I used the rule of thumb earlier: 20% dilution, 25% dilution. So you're probably hoping that if you raise your $2 million, you're at a $10 million post money. So you've sold 20% of your business. That means you start at an $8 million pre-money. That's probably high for a business with 20K in revenue. Probably need to be more like 40 or 50. So if you may want to pull back your round and raise $1 million for that seed, and that would probably be at like a $5 or $6 million valuation. As companies start scaling towards 100K a month or $1 million annually in revenue is where you start to get into the double-digit pre-money valuations and can raise a couple $1 million bucks or more, and then it kind of trends up from there. So think of it as like a 8 to 10x revenue on a pure software recurring revenue business, and then a little bit less if there's a hardware software element or if there's some professional services mixed in with the software revenue.
So I got a line of questioning for you.
Yeah.
That can maybe help with this. So you're going to buy 20 to 25% of the company in the first round, right? And then by the time that company sells, what percentage of the company will you own? Because they're going to raise more money,
right.
You might get diluted.
Right, yeah, so most often, and this is why we reserve some capital and may go from 4 initially to 8 over the life of it, that second $4 million that's going in subsequent rounds is really just to protect our initial ownership. And that's why getting 20 or 25% initially is so important, because over the life of the deal, we're going to be diluted a little bit. And when it's a massive success, we want to make sure we own enough where it pays off. So if you think about a business where we invest $4 million initially and we get 20% ownership, if we invest another $4 million just to maintain that 20%, because to Nick's point, more money is going to come in from future investors, and then it sells for $100 million, that's great. We own 20%, we get 20 million, but it's 20 divided by the 8 that we put in, not 20 divided by the 4 that we put in initially. So we really need the big wins, particularly when we know there's going to be big capital coming in down the road.
Right. So if you end up owning the same 20, see if you maintain your pro rata throughout the life cycle of the company, and then it exits, and you got a $105 million fund, and you probably promised your investors a 2 or 3x return, 3x return, which is pretty standard. So you need to go give them $315 million. So, and like assuming you get 1 out of 10, maybe you get 2 or 3.
Yeah, hopefully we're getting more, but yeah.
Right, like if you're looking at every investment lined up as, this one needs to return everything. So what's 20% of $315 million?
What is that, like 60 something, 62?
Yeah, 62. So you got to sell your company for close to $300 million, right?
Yeah. One way that some venture firms, I won't say that Live Oak thinks about this with every deal, but one way they think about how much they want to own and the potential for a business, back to your question, can it be $1 billion valued business, is if we have a portfolio of 20, 4 of those do really well, can the ones that do really well return the fund? Meaning that one deal returns $100 million in our case. And that means they probably have to be $1 billion business to do that, or maybe a $500 million business if we maintain our 20% ownership.
So how many $500 million tech businesses have been built in Texas in the last decade?
We have one.
What one?
Disco. There's probably been like a handful. Like
there's WP, maybe
WP
20,
Engine,
right?
HomeAway, Retail Me Not, Yeti, CPG, Rig Up.
Right.
Data World.
Right.
How much did Joel Travel do?
but I think compare that number to the number of early stage investments that have been made in the last 10 years, which is in the thousands, I'm sure.
Oh yeah.
And so it's got and so you're probably willing to pay a little bit of a premium in the early rounds.
It's important that we have that meaningful level of ownership early on to have it pay off. And again, most deals are going to be somewhere between getting your money back and a couple times your money, and that's great. That's the name of the game. But it's the big ones when they pay off that they need to pay off in a big way to have venture scale returns.
Well, related, how do you stop yourself from getting diluted?
By just investing more in the follow-on round. So
it's like ante up.
Yeah.
It's like poker.
Yep.
Essentially.
But it's a bigger pie, right?
Yeah.
So,
there's the company has grown in value presumably when new money's coming in at a new round. So as an early investor should feel confident that the company's moving in a positive direction. so maybe I'll
So
say
if they raised 4 million from you, say, hey, we need 50 now.
Yeah.
Come up with it.
Yeah.
You kind of have an idea coming into it what the future fundraising plans are, or
Yeah.
at least kind of a general.
Yeah, there's kind of two elements to that. There's one, what are the entrepreneurs' goals? Do they want to go raise a lot of money because they need to spend on X, Y, and Z?
Yeah.
And then two, does the business model require it? Do we need to build a factory, which is expensive, or do we have to have a massive sales force, which is
Right.
expensive? So,
Right.
what does scaling require?
So along those lines, what's the guidelines that you look for when you negotiate the liquidation preferences and
Yeah.
participation rights?
So we are generally pretty clean on the liquidation preference, and that our preferred equity will just get 1 times
1x?
back. If there's a downturn, you'll probably see those terms become a little bit more investor friendly, but 1x. And then as far as participation rights, I think you mean as far as like pro rata, maintaining our level of ownership, we will ask for what's called preemptive rights, meaning we have the ability to invest in any follow-on round up to the amount that allows us to retain our current ownership.
With a capitalization cap?
Uh,
Valuation cap?
No, not necessarily. So we have the right but not the obligation to maintain our ownership. I guess like you could go raise, if I did a $4 million round at a $20 million valuation, very modest today, good deal. Company skyrockets and goes and raises $100 million at a $1 billion valuation. I have the ability to do my 10% of that or pro rata of that, but I probably won't.
Doesn't that work against you adversely if the valuation is so high that your participation is, so low?
Yeah, chances are if it's that scenario where the thing is taken off, I won't maintain my pro rata, but the dilution will be pretty small because the valuation is so high. So I'm okay to take a little bit of dilution in that scenario.
But you don't see that as an issue in the current market?
No, I think, capital is flowing pretty freely, so as an investor, I want to make sure I maintain my right in case I do want to follow on. But as an entrepreneur, if things are going well, I'm not going to have a problem raising outside bigger rounds down the road.
Because valuations obviously, depends on the the investor, I guess. But I would assume some of that, especially as a VC, is focused on forward earning potential. So, or a lot of it, but with, like, would you, should a startup be more focused on, like, scaling? Like, cause the thing is, like, that's not been my issue, like, I could, that's not a problem, but the churn, so right now we're at, like, literally, like, close to, almost a 50% churn.
Yeah.
So, because you mentioned the residual piece of it, like what would you, because obviously I don't want to like slow down the growth, but at the same time, how do y'all weigh those out? Or?
It's less mathematical, so I'm not going to attribute a factor and multiply it by X. At the end of the day, for companies in the seed and Series A stage, we are looking for early evidence in the seed stage and true evidence at the Series A phase of product market fit, which is kind of hard to define, but essentially people want your product and are going to pay for it, and when they use it, they're going to like it and continue to pay for it. And that's more than a handful of customers. It's usually dozens, if not hundreds, depending on where your price point is. It could be thousands and tens of thousands if it's a consumer-facing app. Getting 500 people to download your app is not product market fit. But if you can demonstrate that, and you can demonstrate that you've got a repeatable sales process to go out and get this product in front of these folks and get it in their hands, then we'll be comfortable and the valuation will work itself out. Everybody will be happy. Where churn becomes an issue is churn can be related to the product and not delivering on customers' expectations, or it can be a customer service issue where your product requires some human element and you haven't invested in those humans, and therefore your customers are unhappy and are churning. Yeah. So growing at a really high growth rate and having a really high churn rate kind of wash each other out, and it's not all that interesting. I would focus on maybe a more modest growth trajectory and getting your churn down to something more manageable.
Okay. Got time for maybe one more question from the group?
Have you guys seen multiple seed rounds here, or is it more of a traditional seed A, B I see the West Coast are doing a lot of, hey.
Yeah, there's yes, lots of flavors. Probably less here, but we certainly see it, and we're not opposed to it. You know, I think the natural progression, in my opinion, should be go out and do your friends and family round. It may not really be from friends and family. Call it your angel round. That could be a couple $100K up to $1 million. Start to get some of those paying customers on board. Show a nice upward trajectory, and then go out and raise a seed, and maybe the seed is $2 million. If you really are on an upward trajectory, maybe you can skip straight to an A. Where I think people get in trouble is they come out of the gate and they want to skip the friends and family round and go raise $1.5 million seed, and maybe they can do it, but they're 6 months behind, and they've got to make up traction and get to a point where they can go out and raise at a higher valuation within 18 months, and it's just harder. You're working with less runway because you haven't sequenced things.
That's awesome segue to, I think, the last question I want to ask you before we go to happy hour. But I'm glad we were able to talk a second ago about how when investors are valuing an investment, it ends up being a function of future return potential and deal competitiveness, which is exciting because as entrepreneurs, you end up having on paper this $1 million business, and you know, you guys as entrepreneurs can kind of go out and become these millionaires. But I want to ask you, why might an entrepreneur not want to raise at the highest valuation they possibly could early on, and why might you want to have a lower valuation?
Yeah, that's a good question. I didn't even feed that to you ahead of time. That's great.
Well, this is
the issue with raising at a high valuation, and we see venture firms that are willing to pay high valuations. We see a lot of family offices in particular where you can strike a deal that's very company friendly, founder friendly. The problem there is inevitably when you go back to raise your next round of capital, the company is going to want it to be at an increased valuation to that already high value, and the incoming investor is going to look at it and say, I'm not sure how there was that much value there before. If this is the founding team's expectation, maybe it's not worth my time, because I know I'm not going to come in at a valuation that's ahead of where they were a year, 2 years ago. So it's a negative signal to an extent, unless the company is just up and to the right, which very rarely happens. So you put yourself at risk for future funding rounds by doing this arbitrarily high valuation today, and it just sets up for either pain down the road when there's a down round, or investors looking the other way because it's just so out of whack with market.
And then even probably a death scenario if you're doing a down round when the market turns down.
Yeah. Going out in a down economy with a crazy valuation and performance inevitably struggling a little bit because of the economy, you just set yourself up for a difficult situation.
Well, let's not do that.
Yeah.
But let's thank Mike for talking with us. Jamie, you have something?
We actually have another like 20 minutes, so we can either head over there and hang out while they set up food and drink, or we can hang out.
Yeah, let's just head over and start the happy hour. I'm sure we can find something to drink. But I did want to introduce y'all to Jamie because he's a badass, and also Jill. So Jill and Jamie are venture associates on our team. It's their job to know every awesome startup in town and then pitch them to our partners and executives. So they're going to lead the train to the kitchen for us. And yeah, we're going to hang around to chat. I'm happy to chat, but they're also great resources for getting plugged in here. Thank you. Thank you.
Thanks, man. That was fun.
Yeah.
That's good.